JJ the CPA here. Hope you're doing well. So year-end tax planning, where does it start? Well, it starts with, in my opinion, what is your tax picture for this year? Meaning if you're down this year, then year-end tax planning may be more you want to save deductions to next year and maybe even pull income into this year. Now, for most, that's not necessarily the circumstances. For most, what they're trying to do when they get to year end is, well, how can I save taxes? So with that in mind, the first thing I want you to note is that really everything's got to be done on or before the end of the year. So that would mean 12/31 would be your cutoff that you would pay for anything that you're going to be able to tax deduct. Now, for small business owners, as well as those that are maybe making some kind of a deduction at the individual level, note this. If you're writing a check, then you would want that check to be dated in the year in which you're wanting to get the deduction, and it would need to be mailed on or before midnight on 12/31 of that year. Now, if you're charging a credit card, pay close attention to this, because the good news is that you get the deduction on the date in which you charge it. It's not the date in which it cleared and showed up on the bank statement, and it's not the date in which you paid that credit card. So the date that you charge it is the date that you get the tax deduction. So if you're somewhere and you're spending money on the last day of the year, December 31st, and you charge your credit card as an example, let's say that's for a charitable contribution and or office supplies. Well, the date on that receipt is the date that you charged it. It would be 12/31. Now, that most likely wouldn't show up on your actual credit card statement until the following year, most likely on the 2nd of the following year, and then you most likely wouldn't be paying that until January of the following year. But the way the law dictates it, very straightforward, that you would get the deduction in the year in which you charged it, because that is then the year in which you owed it. It would be the same as if you're buying any assets with a note, meaning if you sign off on a note to buy a vehicle and you signed on the note and you bought it and you took possession of it all on the 12/31 or before, then that would be the year that it falls into. So if you're buying a vehicle at year end, as an example, it doesn't matter that you titled it in the following year. It doesn't matter that you made your first payment in the following year. It doesn't even matter that you financed all of it or you made a down payment or you had a trade, because you just get to write off the purchase price as long as all those other factors are met. So when you're now looking at planning, what is it that you should run through? Well, the first place I tell clients is this: just look at what your normal expenses are. What are expenses that you're expecting in the early part of next year, and does it make sense to go ahead and pay it before the end of the year? As cash basis taxpayers, which is S Corps and partnerships, Schedule C, Schedule F, doesn't matter if you're an LLC, it matters how you're taxed, but in all those circumstances, you're looking at cash basis of accounting. Unless somehow you're over 29 million and you're doing accrual, which for 99.9% of you, you're not doing accrual. So on the cash basis, know this: the way the law reads very clearly is that you can pay something up to 12 months in advance and get to deduct it on the date in which you pay for it. So let's use an example of rent. So if at the end of December, you decide to pay January and February and March's rent of the following year, well, as long as you've written that check and mailed it to the landlord on or before the end of the current year, well, then you're going to get that deduction even though the rent is in the following year. Now, when you hit the following year, you're not going to realize those deductions because you took it in the prior year. This would be the same thing with health insurance. So what I look at with clients is, let's not just spend money to spend money. Let's make sure that what we're spending money on, first and foremost, is what you're going to have to spend it on anyways. The other aspect is then looking at, well, what did you spend last January? Meaning, if we're in the current year, I would look at January of the current year. What was spent in that January, and was it anything that could have been spent in the prior year? Meaning that might give you a hint of some expenses that are coming up in January that maybe you're not thinking of, whether that's quarterly dues or annual expenses maybe related to insurance. So that's where those things start. The other part is that you really want to know, well, where do you stand? What is your tax going to be for the year? Because sometimes it makes sense to not prepay. Now, the last thing that you can do, and you want to do it carefully, is if you want to push income to the next year, meaning you don't want to report it this year. Well, if you take possession of that check, it's yours. and you would need to report it as income, whether you put it in your drawer or in the bank. With that being said, if you're looking to push income to the following year, you might be in the kind of business where you could simply delay invoicing your clients so that the payment arrives in the following year. Now, of course, you'd want to make good economic decisions related to that, because first and foremost, you want your business to actually get paid and collect on what it is that you are selling. So with all that being said, this is the basics. This is the nut and bolts of what I'm doing with my clients. After that, if we're still looking for some tax deductions, then we would look at what we talked about earlier, the vehicle, but we might also be looking at other assets. But what's key to all of this, whether you're buying an asset or a vehicle or spending money on things, even though you're going to spend them in the future, is it something that you need, right? Don't just spend money to spend money. Because if you were to come up with a $10,000 deduction, it's only going to save you brass tacks whatever tax rate you are at. As an example, if somebody's at the 37% individual federal tax rate, which is the highest it can be, if they had a $10,000 deduction, that's going to save them $3,700 in taxes. That all sounds great, but remember, you spent 10 grand just to save 3,700. That's why this is key to look at, what do I need to spend money on, and should I spend it now? What assets do I need, and should I spend it now? So you might be that you don't have any assets that you need to buy. You may not want to prepay. You may not have the money to prepay. So then what you want to do is figure out, well, what is your tax liability? Ensure that you are paying in enough to avoid any underpayment penalties. So you've always got till the 15th of the following month of the close of the year, meaning January 15th, to try and catch up anything that would need to be due. All your taxes are going to need to be paid on or before April 15th of the following year. And an extension is not an extension of time to pay. It's only an extension of time to file. So all that being said, what we're doing with our clients is figuring all of that out now. What's the tax picture look like? And if you prepaid, if you bought assets, what's the updated tax picture look like? Is that worth it? The other aspect is, regardless of all that, looking at what are we expecting the tax to be based on the most likely outcome. And then have you paid those taxes in? And if not, getting them paid in, but being more importantly prepared for April 15th. All right, hey, I hope that helps. Check out my other videos. I've got some general videos here for small business owners. Got a video here on the vehicle write-off to talk a little bit more about that, SUVs. And then here is another playlist for you, and then I'd love it if you'd subscribe. All right, hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. All right, you have a great one.